Hello, everyone. Thank you so much for being here today. I'm just going to give everybody a quick minute to hop in and then we will get started. Hopefully, everybody can hear me and see my screen. Okay, perfect. So, 2 o'clock on the dot. Well, 2 o'clock my time. So let's get started. Hello, everyone. Thank you for making the choice to invest in yourself and your practice by joining today's financial planning session. Today is all about learning easy to execute strategies to help you have better, deeper conversations by using planning software in real time with clients and prospects. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, Snap's financial planning project lead, who will provide today's demonstration and run the Q&A.
Hello, everyone.
I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab. Any messages you send that way are public to everyone. For private messaging directly to us, please use the Q&A tab. Do we have any responses coming in, Steve?
Yes, we're all good. Thanks, Sarah, Jennifer, Aiden. Lots of participation. So thank you.
Wonderful. Thank you so much. Okay, Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So, some of you here today are already using Snap projections for your financial planning needs. For those of you who aren't already familiar with Snap, Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you'd like to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third party software review site, you will find advisors saying things like none of their clients retire without a SNAP projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. If you'd like to see some content that's more tailored to the way you serve your clients, we've recently updated our website with use cases for various financial planning areas of expertise. And we are thrilled to remind you that the software is now fully functional in French. We are now providing customer support, user training webinars, and product demonstrations with a French language team member. As we move into the case study, we're going to be building out multiple scenarios that we can compare and optimize. We'll start with how to quickly create a basic projection for a single individual, and we're also going to cover how to use the data entry process to naturally discuss personal elements such as taxes and government benefits. Once the plan is created, we'll show you how to personalize as more information is shared throughout conversation. After we've created a base plan with additional personalized plans, then we'll be able to leverage the comparison module to assess the net difference and impact between the basic projection and the updated versions. This is how you can easily demonstrate your own value as the advisor. Lastly, we will cover how to present the information in a client friendly way to ensure understanding and implementation. Before I hand this over to Steve, I just want to clarify one thing. Today's session is going to show you two very different ways you can use the software. With Snap, we can be quick and simple, or we can conduct comprehensive planning. You can sit down with a client or prospect, enter a few data points, and create basic projections that are highly valuable within 10 minutes. This is the first stage of what we're going to show you today. For prospects and many simple client cases, this may be as far as you need to take it. For clients with more comprehensive needs, we can layer in additional personalization, which we will cover in the second part of today's session. So we'll get Steve to take over and log into Snap.
Terrific. Thanks, Alex. And thank you again, everyone, for joining us today. Snap Projections is a web-based platform, so you can access your account from any Chrome browser on any computer without needing to download anything. You'll go to snapprojections.com, and then in the top right corner, you'll click Login to enter your username, password, and the option for a multi-factor authentication. I've entered that during today's session, so I'll go directly into the software, and I'm taken initially to my clients page where I can access any of the projections I've created in the past or get started on a new client file, which is what we'll do today. As Alex mentioned, we're going to be creating two scenarios today. The first is a quick and simple projection that can be helpful in many use cases. The second is a more detailed version of the same plan where we gather additional information, and then we'll compare the two plans in order to illustrate how that additional detail changes the outcome of the projection. So we'll get started entering in our client data for Karen. She was born 1975 on July 1st, and she currently lives in British Columbia. In the top left corner of the software, you'll see that there are three main sections to the tool. There's the scenario setup, where we enter in all of the base client data. This includes things like the date of birth, general plan settings, expenses, incomes, and assets. Once we're done with the scenario setup, we then proceed to the planning pages where all of that information comes together to show us our client's life on one page. From here, we can review information, make changes on an annual basis or for any period of the plan. And then once we're comfortable with all of the numbers, we're ready to proceed to the client report, where we can enter in the charts, tables, and commentary that we would like to include in the final client-facing document. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll go to the General Plan page. We're going to target a retirement age of 60 for Karen, which is in 10 years' time. We're going to run the projection until age 100, and we've pre-populated our plan with our default inflation rates and rates of return. The inflation rate is taken from the FP Canada guidelines, and our rates of return are also use the FP Canada guideline gross assumptions, and then we've reduced those for expected management fees in order to arrive at a net return assumption. Once you enter in your values, you can click defaults and then save the current page settings for new scenarios. And this is common throughout Snap, where you can personalize your planning experience, enter in various assumptions, and then save those for all future scenarios. Clicking next, we'll go to the expenses page, and there's lots of flexibility in terms of entering expenses in Snap. If the client has a budget in mind, you can enter that information here. If they have itemized one-off transactions that they want to work towards, things like giving a gift to their kids or purchasing a car every 7 years, you can also enter additional expenses, or you can actually leave this page entirely blank. And when we get to the planning page at the top, Snap will help us to calculate a reasonable budget for the client given their current cash flow or what would be a sustainable level of spending to avoid running out of money over time. In this case, we do have a target spending goal of $50,000 per year. This is going to be indexed for inflation and net of tax. This is also net of anything else that's being modeled in the plan. So if we add a mortgage or any insurance products, this will be on top of those cash flow needs. We can also enter in additional travel of $5,000 a year. And she's looking to do that for the first decade of retirement. So we'll run that from age 60 until 69. And then we'll highlight that in the reports so that there's a specific legend item in the charts, and we can draw attention to that goal being funded. I'll click Next, and we'll go to the incomes page. Karen is currently earning $110,000 per year. We can set an indexing rate either on a custom basis, or we can delete any value from the cell, and that's going to link it directly to the general inflation rate so that it increases over time for cost of living. It's being entered as employment income, so SNAP is going to automatically deduct CPP and EI. It'll be taxed appropriately, it'll earn additional RSP room, and it will run from the first year of the plan until the end of the year prior to her retirement. If we want, we can add other income sources like a rental property or an inheritance in a future year, and we can enter in defined benefit pension plans. So I'll enter that for her, which she will start at age 60. Her age 65 amount, including the bridge benefit, is $35,000. She's expecting about a 1% annual indexation. And then once the bridge benefit drops off, she'll receive $28,000 a year going forward. Clicking next, we land on the assets page, and you'll see by default, Snap adds a non-registered account to all projections just to provide a location where Snap can allocate surpluses in the future if needed. It also shows how you can input new accounts into the software. In this case, because Karen already has a non-registered, I'm going to delete this account and I'm going to enter in her existing account information. So she has a non-reg with 40,000 currently, and that's invested as 30% fixed income, 70% equity, and it has a cost base of $30,000. You'll see that Snap pre-populates the rate of return assumption for each of the asset classes based off of the general settings that we entered earlier. And you do have the option to change those returns on an account by account basis as needed. She also has a tax-free savings account, which currently has a balance of $70,000. And that's similarly invested as 30% fixed income and 70% equity. She also has an RSP with a balance of 180,000. And she has a locked-in retirement account with 45,000. Now that we've added all of her financial assets, we'll scroll down to the real assets section where we can enter in her home with a value of 600,000 and original cost of 400,000. We can customize the appreciation rate, which defaults to the inflation value in the projection. We can indicate if there's capital gains applicable to the sale, and then we can model the future sale or purchase of a property as needed. So if they're saving up for a cottage or an investment property, or if they want to downsize at retirement, we can model all of those transactions from here. I'll click next and go to the debts page where we can enter in her mortgage, which has a current balance of 170,000, interest rate of 5%, and monthly payments of $1,800. We'll link that debt to the home so that if we sell the property at any time before the mortgage is repaid, Snap will automatically use the proceeds to finish off the mortgage. And finally, we'll go to the government benefits page where we can customize assumptions for CPP and OAS. We can set the start age, which defaults to the client's retirement. I'm going to assume that she waits until 65 in this case for our base scenario. And then you'll see that Snap, because we don't have all of the information we need to calculate the exact expected CPP, we assume the national average, which is 57%. You can enter in a percentage of maximum based off of the client's employment history and expected future earnings, or you can enter in the dollar value if they're already receiving CPP or if they have a Service Canada statement. In this case, our best estimate is that she'll receive 85% of the maximum once she starts taking it at 65. So we'll have Snap automatically calculate the expected annual income. For old age security, we'll start that at 65 with a default assumption of 100%. And just like that, in a little over 5 minutes, we've entered all of the scenario setup data for Karen's case. You'll see that we do have additional pages available on the left. We could add insurance policies, and that now includes life, disability, and critical illness. We can add RESPs, customize additional settings, or add corporations. But for this first plan, the simple version, we're ready to proceed to the planning pages where all of the data that we've entered so far will come together to show us Karen's life on one page. Now, the planning page can seem overwhelming the first time you see it, but once you know what you're looking at, it's incredibly intuitive and a very powerful section of the software. On the left, we have the year and our client's age. Then we have their calculated discretionary cash flow. This is the amount that Snap has determined is left over after calculating and accounting for everything else in the plan. So this 60,000 figure is being determined by taking 110,000 of employment income. Snap is subtracting off CPP and EI. It's subtracting off taxes payable, and it's subtracting off the mortgage. And that would leave Karen with about 60,000 that she can either allocate for savings or have spent. And that process continues until retirement, at which point our target spending goal of 50,000 is set to kick in. Snap indexes that for inflation over time. We've got the additional travel, and then we've got available sources. We have two options for accounting for savings during her working years. The first would be to turn on the cash flow management from the first year. In this case, our target spending of 50,000 would start as of the first year of the plan, and any surplus cash flow will be automatically saved into her financial assets. Alternatively, we can choose to directly enter in her total savings into her various accounts, which tends to be the more conservative and accurate way to model pre-retirement savings. So I'll go to the TFSA, I'll enter in her annual savings amount of 5,000, and I'll copy that down into her last year of work. Then for her RSP, I'll similarly enter in her annual contributions, copying that down. Anytime that you make a change on the planning page, you'll see that the run button in the top right turns yellow, and Snap is waiting for us to click that to recalculate everything throughout the page. And this is just to prevent the software from constantly refreshing and changing as you're making adjustments to the projection. So now that I've clicked Run Scenario, all of the numbers have been recalculated and the button shows as green. On the left, we can see that the remaining cash flow has now been recalculated, accounting for her contributions. So she has about 51,000 left over for personal spending outside of the projection. Continuing down to retirement, we can see her total annual cash flow need, and that's being funded by her pension income. And then Snap is automatically withdrawing from her various financial assets in order to provide the amount of cash flow required. So we can see withdrawals from the non-reg, the TFSA, the LIF, and then eventually out of the RIF. And that process continues until the final year of the plan, at which point there's about $260,000 remaining across her financial assets. So in this case, she is on track for her target retirement goal. We can also review this projection in the form of charts. So if I click on charts at the top, we can see the outflow chart where all of her cash flow is going each year. So we have the base expenses. This is how much she has for spending on items outside of the projection. We have the additional travel, income taxes, debt payments, financial asset contributions. We can see where the money is coming from on an annual basis, whether it's pension income, employment income, or withdrawals out of accounts. And then we can see the available resources broken out by category. And all of these charts are fully interactive. So if I click on any of the legend items, I can add and remove that to the chart. And then I can also hover my mouse over any annual values in order to get more information. And just like that, in a little over 10 minutes, we're completely done with Karen's plan. And in a lot of client cases, this is really all they need in order to gain a lot of insight and information. So Karen has a good sense that she's roughly 10 years away from retirement. She understands that once she retires, roughly half of her needed income will come from her work pension. There will be some income coming from CPP and OAS once those start, and then she'll draw down on her financial assets in a tax efficient manner to fill in any gap. So from here, we could provide the client with a report and they would be quite happy, continuing on with their current process, knowing that they are on track for their goals. So looking at our two plans for today, the first was the base assumptions where we spend about 10 minutes entering in data, discussing the projection with the client and giving them a good sense of where they're headed. And this is best for clients with high level questions. So in this example, am I on track for retirement in 10 years? In this case, we don't have to be as specific with the information because a lot of this is unknown. The rate of return will be different than what we've modeled. Their exact retirement timing might be different. So we really just want to give them a good sense of where they're headed and try to flag any potential concerns or opportunities. Now that we're done with the base scenario, I'll show what you can do with Snap using all of the additional settings and functionality if you wanted to create a more detailed projection. And in this case, we're going to spend about 30 minutes total. So we're going to add 20 minutes to really tailor the plan to the client's unique case. And that's going to be for things like, if a client comes to you and they say, I want to retire in 6 months on July 1st, and I want to know where I should start pulling my cash flow from. So for something so immediate and detailed, we would want to take a few additional steps in order to tailor the plan to their exact situation. The additional steps that we're going to take today include prorating the first year of retirement. So we'll show you how you can assume an exact retirement date instead of assuming that they would retire at the start of the year. We'll show how you can refine taxable income assumptions. So we'll enter in things like charitable donations. We'll adjust the target taxable income that they're going to take in retirement. We'll adjust registered account settings, and then we're going to change future rates of return and borrowing costs. And all of this, again, is to just give the client a slightly better idea of where they're headed and to tailor the plan so that they feel that it's more for them and that it's reflecting their exact situation. So we'll go back into the software and we're going to update the title of the first plan that we created. So we'll call this Scenario 1, Base Assumptions. And then I'll click on the menu option in order to copy this scenario. In the new plan, you'll see that the title shows copy at the end. I'm just going to adjust that and we'll call it Scenario 2, Detailed Assumptions. And we're going to start by prorating the first year of the client's retirement. Right now, you'll see that as of January 1st, 2035, the assumption is that employment income stops and pension income starts. But if a client is going to work until April or July, we can prorate the values so that it's even more accurate. So we'll go into Scenario, go to Incomes, and then we will go to the to age for the employment income, and we'll click on the gear symbol within the to age cell. And that allows us to customize the exact date that that's going to run until. So we'll do until July 1st. Similarly, we can prorate the pension so that it starts as of the client's birthday. In addition to prorating the first year of retirement in this case, we can also prorate the government benefits once those start. So we'll click on prorate first year of CPP, and that's just going to assume that they start receiving it the month following their birthday. And we'll do the same for OAS. Now, when we return to the planning page, we'll be able to see all of those values have been prorated for their associated year. So in 2035, we have half a year's income and then half a year's pension. Similarly, in 2040, when she turns 65, we're only assuming half a year's CPP and OAS. As a result of those changes, we can now see that in 2035, there's really no assumed withdrawals required for the year because she's going to have enough cash flow throughout the first half of the year to fill the gap of what she would need throughout the full year. And so on a 10-year or 20-year horizon, that's not a material difference from our first plan. But for a client retiring next year, that can mean the difference between starting a withdrawal plan or leaving it until 2036. So now that we've prorated the first year of retirement, we're going to move on to refining taxable income assumptions. So if we go back into the software, we have detailed breakdowns of things like taxable income. So we'll see in the first year of the plan, our assumed taxable income is 104,103. If I click on the taxable income details table, I can see a breakdown for how that's calculated. So we've got 110,000 of employment income. We have deductions associated with the enhanced CPP program, as well as the RSP contributions. And then we have some investment income assumed on her non-registered portfolio. If I go into scenario setup, down to the settings section that I mentioned earlier, I can go into the portfolio settings and adjust how the equity returns are being taxed in her projection. So in most cases, we use default assumptions, which applies to a globally diversified, fairly passive investment portfolio. That's going to assume some of her equity returns are capital gains, some are dividends, and both Canadian and foreign. In this case, the client's portfolio is more heavily skewed to Canadian companies. So we're going to increase the Canadian dividend allocation and reduce the foreign dividend allocation. So going back into the planning page, we can go back to that taxable income figure and we'll see a higher Canadian dividend assumption and lower foreign dividends. So we can really tailor the plan again as needed in cases where it's material in order to more accurately project out the client's future. Next, we're going to go to scenario setup and then settings and charitable donations in order to turn on a dedicated feature where we can model a client's charitable donations, either cash, in kind, or insurance based donations. And this is going to give us the ability to show how much she's claiming, how much that is saving her in taxes on an annual basis. And it will also help us to plan around whether to carry forward any claim any claimed donations for a future year. So I'll enter in 2,000 a year of charitable donations. I'll run the scenario. And then Snap will show us how much they're claiming each year. And this would, of course, change if they don't need to claim it in order to bring their taxes down to zero. It would carry it forward or split it with a spouse if applicable. And then we can see how much they're saving in taxes and what their taxes would be with and without the donations. The final thing that we'll do in this plan related to taxable income is we're going to use a brand new feature that was just added to Snap, which allows you to set a target taxable income for each year of the projection. So you'll see right now in the first year of full retirement, so once the employment income is fully done, Karen is currently projected to have $42,609 of taxable income. And this is broken out as pension income plus some withdrawals out of the locked in account and some non-registered investment income. You'll see that the marginal rate is 20% and the effective tax rate is about 7%. So there may be an opportunity to take out additional taxable income in this early period at the 20% bracket in order to avoid taking out as much in later years at a 28% bracket. So what we would do is we'll turn on the new feature under the taxable income column. We'll enable that and we'll start it as of the first year of full retirement. And then what I'll do is I'm going to enter in a target which is aligned to the top of the lowest tax bracket in BC. So we just want to take out as much of their taxable income up to that 20% threshold while they have the opportunity. So I'll enter in 49,000. I'm telling the software that's in today's dollars. So because marginal rates are indexed with inflation over time, we want to increase that in the future so that we're taking advantage of the full expected lowest bracket. And then I'm going to copy that for all years of the plan. So you'll see Snap has determined that in the first year of full retirement, the top of the lowest bracket should be closer to 61,500. So that's going to be our target income goal. So when I run the scenario, Snap is going to take out additional registered money in order to reach that target. So now you'll see our actual taxable income is equal to the target that we entered. And that's being achieved by taking out additional registered money for those first 5 years until CPP and OAS kick in. And this can be a great way to try different strategies and illustrate to the client the advantages of working with you and doing tax planning on a decumulation basis. Coming back to our list of detailed adjustments, we're going to next adjust the registered account settings. So if I go back into Snap on the scenario setup assets page, I have these tabs for each of the registered account types. So if I click on TFSA, I can enter in any carry forward contribution room. So in this case, she has some unused room. She has 40,000 available. And then for the RSP, she has 55,000 available. Now, this might not actually impact the plan if she's not maxing out her accounts, but it does allow us to be more accurate in future projections. If we update the plan and she gets an inheritance or she sells her business or her home, then we could ensure that Snap has the information that it needs in order to max out accounts in a future year. I'm also going to go to the LIRA and I'm going to set that to a federal jurisdiction, and I'm going to unlock 50% of it when it converts to a LIF, and we'll unlock that into the RSP. So now that I've used the registered account settings to tailor the plan for those aspects. I'll go back to the planning page and we can see the impacts. So you'll see the lift is cut in half once it's converted. So it drops from 64 down to 33, and that money is shifted over into the RSP. And if I hover my mouse over top of the TFSA contribution in the first year, you'll see that the contribution room assumption is now 40,000. The last thing that we'll do for the detailed plan is we are going to adjust the income, or sorry, the rates of return as of retirement. So right now we're assuming 30% fixed income, 70% equity, total 4.1% portfolio return. Once they retire, I'm going to click on the rate of return and I'm going to change their asset allocation at that point in the plan to 40% fixed income and 60% equity. And then I will apply that to all of their personal assets. So now each of the accounts is going to decrease to 3.8% return from that point on. They are also expecting to renew their mortgage next year. And currently the rates are about 4.5%. So we'll click on the 5% rate starting next year, change that to 4.5, and then we'll adjust the expected annual payments required to maintain their current repayment schedule. So now adding in another 10 minutes, we've adjusted all of the settings and we have a much more detailed projection that is going to really feel like Karen's plan. She's going to look at this and she's going to see the prorated incomes, she's going to see the mortgage renewal, and she's going to understand that this is really tailored to her situation. As we scroll down throughout retirement, we can see whether she's still on track for her goal, given all of the updated information we've included. And in this case, she is still on track with a small buffer at the very end of the plan. We could also review the plan through the recommendations tool. So you'll see right now she has an overfunded status with 123 surplus at the end. We could calculate the sustainable spending to see how much more she could spend throughout retirement in order to still be on track for her goal. In this case, it's a small buffer of about 600 a year that she could increase if required. If she was off track, if she had a shortfall, we could use things like the savings calculator to see how much more she needs to save, or we could see whether an alternative retirement age would help to resolve the issue. Now that we have our two scenarios, we can compare them to one another in order to see how much of a difference did all of that additional work really make on the projection. So I'm going to select our two plans. I'm going to click Compare Selected Scenarios. And now we can see a summary of the differences between the two plans. So our original base assumptions had 105% of what we needed for all of our input goals. And then after all of our adjustments, that dropped to 102%. So very, very similar on a long-term outcome basis. And this is what I mean when I say 80% or more of the value of the plan is created in that first 10-minute process. You know, we're very directionally indicating where the client is headed. And all of that extra work is still valuable as needed, but it's not typically going to make huge swings in the client's outcomes. You'll notice that some of the adjustments that we made are beneficial to the client. So prorating the final year of work added about 60,000 of income, but then reducing the rate of return at retirement is going to decrease how much they have available. So adjustments will typically offset one another, but ultimately by adding in all that detailed information, you're going to get a more accurate long-term outcome. And then we can see what the other changes were to the plan that are causing differences in outcomes. So a major one is that by setting that target taxable income, we reduced their lifetime taxes payable by 137,000. So that was a huge benefit to the plan. But by prorating government benefits for the first year of CPP and OAS, we knocked out 20,000 of income. In the end, the final estate after tax is different by roughly 10%, a little less than 10%. So again, still valuable to do that additional work if you have the time and the information, but not a requirement by any means. In addition to the summary, we can also look at trends to see differences in the plan over time. So here we have the differences in personal taxes. So once we factor in things like the charitable donations and once we smooth out taxes payable in retirement, you'll see that the taxes paid on an annual basis are quite a bit different between the two plans. Similarly, for government benefits, they're almost identical because all we did was prorate that first year of retirement. And then with personal estate after tax, the plans are quite similar over time, small differences, um, but ultimately the one is more accurate for what we've modeled. So now that we're done comparing the two plans, we could export any of the summaries. So if you want to print the charts or if you want to print the summary table, you can do that from the comparison tool. We would then close the comparison section, go back into our desired plan. In this case, it'll be scenario 2. And then we would click on Client Report in order to create a custom PDF summary of the projection. The way that you create custom reports in Snap is you would start with the report builder, and then you'll pick which pages you want to include for the client. And we start by default including all available charts, tables, and commentary. This gives you the option to include and exclude whatever makes sense for you and your client's needs. We do have some sample reports and templates that you can use in order to get started, but ultimately, once you get more comfortable with the report and what your clients are looking for, you'll be able to create a custom list of pages to include. So for example, I'm going to remove a few pages from the report. I'm going to get rid of the financial asset flows, and I can do that by just clicking on the page and then hitting delete on my keyboard, or I can click on it and drag it outside of the included pages section. So that's going to remove it from the report. I always have the option under the gallery to go and add it back in. So you'll see now that I've removed the page, it's available here, and I would just drag it back in wherever I want it. I'm also going to get rid of the goal details, the cash inflow details, the asset allocation chart, and the recommendation details. Next step is to go to the report editor where we can change what content is included in any of those report pages. So for instance, if I go to goal summary, you'll see that Snap has pre-populated a summary of the projection. So we have the retirement age, the year, what she's spending before retirement and after. And all of these values are referencing specific variables in the plan. So it's not hard-coded numbers that you need to update if you make changes. The report updates in real time as you make changes within the projection. And you can even use those variables within your own commentary. So if I say additional travel, starting at, and then on the right here, I have access to all of those variables. So at age 60, in, and then the retirement year. So if I change the retirement timing in a projection, the report will update as well. We have the assumption summary where we can see our pre and post rate of return. We have the goal status of 102%, and then we have the calculated sustainable spending value that we saw earlier. We could also add a note, like leaving a larger estate. And then we could continue that process, reviewing each of the pages and adding comments or adjusting things like the charts. And then once you're ready, you would click Report Preview, review all of the information, and then once you're comfortable, you would click Generate PDF. So here we have our uploaded logo, we have our customized background, we have our note to reader explaining that it's not a guarantee of future outcomes. We have the executive summary, what we call the snapshot, which shows a high-level summary of the projection in order to give the client a good understanding before they start diving into all of the detailed pages to follow. And you can even create a one-page report that just includes this simplified view. It all depends on your practice and your clients and what they need to move forward. And then we would have more detailed pages available to support. So that's everything that I wanted to show for the client case today. We've gone through a base assumption scenario and then a detailed assumptions case, adjusting all of the settings that are available throughout Snap. We have only showed a fraction of the capabilities of the software today. If we go back to the planning page, we have things like stress testing, which allows you to use historical or randomized rates of return throughout your projections instead of static annual returns. We have needs analysis to help calculate whether the client has enough insurance in place across the three main categories. As I mentioned earlier, under scenario setup, we can add corporations to the projection. So as you come across different client cases, you'll have the features and capabilities available in the software. And if you do have questions about using any of the tools, you can go to help in the top right corner and then help center. The second you sign up for your free trial, you'll have immediate access to our help resources and our customer success team. You can give us a call, send us an email, or find answers to your questions through previous webinar recordings or typing in key terms like how to enter an inheritance. And then you would be able to access dedicated articles for that. With that, I'm going to pass it back over to Alex in order to open it up for questions after walking through a few additional steps.
Wonderful, Steve. Thank you so much. We are here to address any and all of your questions in just a moment. If anyone would like to see, for example, how to set up a corporation, how to conduct a life needs analysis, anything you're wondering, send it through the Q&A tab now, and we will get to as many questions as possible. So you saw at the beginning that we do have a special offer for those of you here with us today. We are going to give a special gift to every single advisor who signs up for a free trial of Snap Projections today. Each one of you who starts before midnight Eastern Time today will receive an extended 1 hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do here today. The snapshot is very flexible, but it's most often used in 3 different ways. It can be used as a standalone client deliverable that essentially replaces the longer client report. You can keep that to 1 or 2 pages. It can also be used as a 1 or 2 page quarterly or annual review template. And it can also be used as the executive summary to the full comprehensive report, which is what you saw Steve create just a few moments ago. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one on one to create your snapshot template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you will see there are 2 plans for you to choose from as an independent advisor. The advisor business is the plan you want for the corporate module. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. I have already actually dropped the link in the chat now, which is what you can use to create your Snap Projections account. That will get you instant access to the software and ensure you get to take advantage of the special onboarding and training package being offered to everyone who starts today. So please click on that link now so you have it open up on your device before the session closes out. And I will also send those via email. For those of you here today who are already using Snap, thank you so much for being a valued member of our community and for making time to be here with us today. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor gets an entire free month of service when the person they sent our way becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There's no limit on how many times you can do this. We've created a new referrals page that you can access from within your Snap account that makes it easy to take advantage of the Snap referral program. Okay, so let's move on to your questions. So the first question, Steve, can you show us? I know you covered the snapshot briefly when you were creating the report, but can you show us how you would create and show just the single one-page snapshot?
Yes, definitely. So if we go into the client report where we created our initial view, you'll see that this includes lots of information. We have a cover page, note to reader, then the snapshot section, and then all of the supporting material. If I go back into Report Builder, where we select the pages to include, there's two options that I can use. I can either remove all of the other pages that I don't want. So I would just go through, click on them, delete them, or to make it even easier in the top right here, because this is such a common use case, we have a toggle for snapshots only. And what that does is it grays out the other pages. So you don't have to get rid of them from your report or your template. You would just ignore them for the purpose of this plan, and now when I go into report preview, you'll see that there's only the snapshot content. So that would be how you can really quickly create a one-page report from your projection.
Perfect. Thank you. All right, next question. Can you explain a bit more detail on setting up donations and show us any way that that's included within the reporting?
Yeah, absolutely. So for charitable donations, there are three main ways that you can incorporate that into the plan. The first that I showed is to assume a cash donation. So this is just going to take cash flow out of the client's projection, and it's going to donate that money, and then it's going to provide the client with the associated tax benefits. As an example, let's say that I donate $50,000 in a particular year, and then I run the scenario. You'll see that under the charitable donations module, I'm not claiming the full amount. I'm only claiming enough to bring my taxes payable to zero for the year, and then I'm carrying forward the remaining amount. So this can be a helpful tool to plan around larger potential donations in terms of how to split that between spouses, how to carry that forward, how long you can carry it forward. So Snap will factor all of that into the projection. In addition to cash donations, I could also make in-kind donations. So under the non-registered account, I could assume that they're going to donate $10,000 of shares, and then I can indicate what the cost base is of those shares so that Snap can accurately calculate the remaining portfolio. So that again is a common strategy in order to avoid the capital gains taxes payable. So you can donate in kind and then model that in the software. And then the final option is if I had added insurance policies to the projection, I could donate either a policy and have the premiums applied as a donation, or I can have the charity as the beneficiary of the insurance. So there's quite a bit of flexibility, and of course, there's articles outlining all of the options available, depending on the use case that you want to model. And then we would be able to, make reference to any of the charitable donations that we want to kind of include either under the recommendation summary or recommendations details pages. We could include that in the report and then add commentary about the recommended charitable donation strategy.
Fantastic. Thank you. All right, next question. Can you show us how to set up a corporation?
Yes, so in the top left corner, we can click on Add Corporation. I'll enter the corporate name. We'll enter in the province, and then you'll have the ability to set up all of the small business deduction eligibility and the notional account balances. The thing that I always mention is you can leave these values as the default in Snap. So for the notional account balances, if you leave those as zero, you're just creating a more conservative projection because it's not going to have the tax advantages associated with those accounts. If you do have the information, either from the client or their accountant, then you can add that here, and it's just going to, again, create a more accurate projection going forward. Snap calculates all of the notional accounts starting in the first year of the plan. So this is only related to the starting balances. In addition to the notional accounts, you can enter in the ownership structure for the corporation and then the disposition assumption. So how is the corporation going to be disposed of? When will it be disposed of? And how will the taxes be calculated? So you have settings available, and then Snap does all of the work itself. Once you've set up the corporate page, Similar to the personal side, we have all of the scenario setup capabilities. So we would add assets, say that have some existing investments of 500,000. We could enter in real assets if they had a building or equipment that we want to show being sold. We can add in debts with or without tax deductibility. We can enter in insurance policies, and then we have similar settings capabilities to what we saw on the personal side. Once we're done with the scenario setup for the corporation, we'll click on planning pages. And the great thing about Snap's corporate module is that you can model both the operating business and the holding company as a single corporation, or you can just model an operating business, or you can just model a holding company. So regardless of what the combination of accounts are that you want to include, you can do that all within a single corporate structure. So in this case, I'm going to assume that she's earning 500,000 a year of active income, and that will continue until age 59, indexed for inflation. We'll assume that she's paying herself a salary out of the corp, and that she has other expenses of 50,000 a year. Once I click run in the top right corner, Snap will then calculate the taxable operating income. It will determine the total taxes payable given the small business deduction and the rates applicable, and then it will deposit the retained earnings into the corporate investment account. So it's taking 340,000, subtracting off the taxes, and then depositing the rest. And then we can see the account grows over time until retirement, and we would have about 4.5 million in the corporation at that point of the plan. And then on the right, we would have the ability to distribute dividends that would then be included on the personal side for spending purposes. So that's a very high level view of how you can use corporations within the projection. There's lots of additional information similar to the personal side. So if I click on balances, I can see the expected GRIP and capital dividend account, RDTOH balances over time. And then I can use those in order to do tax planning if I want, or I can just keep things simple and conservative and just use non-eligible dividends for the purposes of modeling the projection. Then if you go back to the personal side, we'll see that everything that we did in the corporation is included in the plan under the corporation section. So we can see the value of the corp, we can see the salaries being paid out before retirement, and then the dividends after retirement. And that's going to get factored into the drawdown strategy in order to try and reach the target taxable income and reach the spending need.
Fantastic. Thank you so much. All right, next question. How does it work if annual spending varies over the years of retirement?
Yeah, so we can do that in a couple of different ways. The first would be to enter in additional expenses. So if I go here and I say, car purchase of 50,000 indexed for inflation, and we're going to do that every year until they turn 80. And then we're going to highlight that in the report. We could have gift to children for 100,000. And we could do that at, say, age 65, just as a one-time event. So we can either add in additional expenses here. We could also do something like assisted living of 80,000 a year, starting at age 80 until the end of the projection. So you can either use the additional expenses functionality, and then when we go back to the planning page, we'll see that in retirement, all of those expenses get included, and then we have lump sum withdrawals happening out of the accounts in the associated year. So now there's a lump sum withdrawal at age 65 in order to fund the gift to the children of 100,000. And then later on, once they go into assisted living, we can see that there's larger withdrawals happening. So you can either do it that way using itemized additional expenses, or you can use the real base column and change it over time. So some clients will use the go, slow go, no go methodology where you have kind of periods of retirement spending at different levels. So you might want 60,000 a year until age, say 69. And then we would go down to 50,000 at that point. And then we could go even forward to age 85 and drop that down to 40,000. So you can tailor the base expenses that way if you wanted to adjust spending over time in the plan. So those are the two options, and they can also be used in combination as I have here.
Fantastic. Thank you. All right, next question. Can you explain a bit more how to use the target option when optimizing the tax implications when withdrawing for the accounts? Is it the same when planning for a couple? So that's coming back to the taxable income targeting and the decumulation component of that as well.
Yeah, so the feature can be used both for individual clients and for combined scenarios. Typically, you would have the same target taxable income for each spouse, just because that's going to allow the household to typically pay the lowest amount of taxes. The software will also use pension income splitting to try and equalize the two spouses if they do have the same target. So that allows the most efficient approach in most cases. The references and what you might consider for the target would be things like the marginal rates. So obviously, each province has their own combined federal and provincial tax brackets. So you could look at what threshold is the client likely to be in throughout their retirement period. So here we can see that the client is spiking up into the 46% threshold now that we've added in the corporate dividend distributions. So in this case, if I was planning for this client and the higher income, I would bump up the target in order to try and take out more money during this initial period under the 44 or 46% bracket. So if I can get more out at 40, that may be beneficial to the client's situation. That said, it's a very complex planning problem because taking out money early at a lower marginal rate might be helpful. But if that money is just going to sit in a non-registered account for 30 years being taxed on an annual basis, it might end up hurting the client in the long term. And so it depends on what the client's other resources are, whether they have TFSA contribution room, whether they're investing into corporate class funds that might not have annual tax drags. So there's a lot of complexity that can get brought into the case. And so the advantage is you can run multiple scenarios in Snap and then compare the results to see what the best option is. So you could run one scenario with a target of 60,000, another scenario with a target of 90, and a third with a target of 120. And then you would compare those three plans similar to what we did today and take a look at the long-term outcome in each of them to see, would one benefit them on a long-term basis. So here, obviously, scenario three is highly skewed because we have a ton of corporate money added, but you would be able to see the difference between the projections as to whether one is better than the other and over what period they're better. So for instance, here we can see that taking the additional taxable income is preferred for about the first 20 years of retirement, but then having left the money in the RSP to grow is better for the last 20 years. So Snap has the tools and the capabilities to be able to help you make those planning decisions. And we have a lot of webinar recordings on this topic just because it's such an important one. We want to provide both the tools in the software, but then also the support with handling those conversations.
Fantastic, Steve. Thank you so much. We're just 2 minutes away from our end time. I know many of you likely have meetings on the hour, so we are going to wrap this up now to be respectful of everyone's time. Everyone who is here live will receive an email tomorrow that will include the form to fill out to request your CE credit. If your question was not answered live, I will follow up with you via email. You will get the answers that you are looking for. Thank you so much for being here with us today. And I hope this has been a valuable session for all of you. Enjoy the rest of your day. And I'm looking forward to continuing the conversation offline. Bye for now.